It is wild when you see a company sign a massive 5-year contract renewal with their absolute biggest client.
Yeah, usually that is the holy grail. I mean, it practically guarantees your revenue charts just go straight up.
Right, and in this case, we are talking about T-Mobile. They actually put pen to paper on this huge multi-year agreement.
Managed services, software development, and even some cutting-edge AI innovation, right?
Exactly. So on the surface, the math seems incredibly straightforward. You lock down your anchor tenant for another half decade, and your financial models get a massive boost.
Sure, yeah, it makes everything super predictable.
But then, literally on the exact same earnings call where they announced this triumph, management delivers a jarring caveat.
Oh yeah, the warning.
Right. They explicitly warn that revenue from that exact same client, T-Mobile, is actually going to decline this year.
Which just creates an immediate friction in the narrative, Because Wall Street models, they are built on linear expectations. So a blockbuster contract renewal combined with a downward revenue revision, it forces you to stop and just completely reevaluate the mechanics of the whole relationship.
It is a paradox that completely shatters the basic calculator we use for corporate earnings. So welcome to this deep dive.
Glad to be here.
Today, we are taking you into the engine room of enterprise software and telecommunications. Our focus is the Amdocs Limited Q1 2026 earnings call.
Ticker symbol DOX.
Yes, DOX. And we are running this through our Talk Tickers framework.
Which means we are letting the raw data lead the conversation today.
Exactly. We are stripping out the dense Wall Street jargon, and we are going to extract the actionable signals for anyone who owns this stock or, is just looking at the telecom space and considering a position.
Right, because we have to figure out how a company can win so big and yet forecast a near-term contraction with their absolute best customer.
So to solve that paradox, we have to establish what Amdocs actually is.
Yeah, because they occupy a very specific, kind of invisible, but incredibly lucrative layer of the global economy.
I feel like most people interact with Amdocs technology multiple times a day without ever seeing their logo.
Oh, 100%.
Yeah.
They're the operational foundation for the world's largest telecommunications companies.
Right. Like if you are a retail investor looking at the tech sector, you see Apple, you see AT&T, the consumer-facing brands.
But Amdocs sits entirely behind the curtain.
Yes. We are talking about the BSS and OSS stacks.
Right. Business support systems and operation support systems.
Which, in plain English, means what exactly?
Well, it basically means they build and run the incredibly complex software that handles everything. Billing, customer relationship, service provisioning, network monetization.
So if I take my phone off airplane mode in a foreign country and I stream a 4K video over a 5G connection, and then I seamlessly get a prorated charge on my family plan.
And the network does not crash.
Right, without it crashing. Amdocs is the software orchestrating all of that logic behind the scenes.
Exactly. And that logic has grown exponentially more complicated over the last decade. I mean, it used to be about just tracking minutes and text messages.
Oh, back in the flip phone days, yeah.
Right. But today, they are handling massive cloud migrations for tier 1 global players. They are modernizing legacy tech stacks that have been cobbled together since, like, the 3G era.
And crucially, as we will see in the data for this quarter, they are attempting to revolutionize this entire infrastructure using generative agentic AI.
Yeah, their new AOS platform.
Which we will get into. But basically, they manage the mission-critical plumbing for companies like AT&T, Vodafone, and T-Mobile.
Yeah, if Amdocs software goes down, these telcos essentially stop making money. It is that serious.
Which gives them an incredible economic moat. So let us get right into the raw data for the first fiscal quarter of 2026.
Let's do it.
Because before we debate the future of AI and telecom, we have to look at the scoreboard. And the top line number is massive, $1.56 billion in revenue for a single 90-day period.
Yeah, $1.15 billion. That translates to a 4.1% increase year over year on a reported basis.
Okay, 4%, not bad.
But the metric that management rightly emphasized was their growth in constant currency, which came in at 3.5%.
Right, because of the currency stuff?
Yeah, the CFO, Tamar Rappaport-Dagim, highlighted that they faced a $3 million unfavorable foreign currency headwind.
Right.
But despite that currency drag pulling down the reported figures, the underlying operational growth still allowed them to slightly beat the midpoint of their own internal revenue guidance.
Which is always good to see. And, it is the regional breakdown of that revenue growth that tells the most compelling story about where telecommunications capital is flowing right now.
Oh, absolutely. It is decidedly not a uniform picture.
Not at all. I mean, North America, which is their primary engine, grew at a solid, if unspectacular, rate of nearly 4%.
Pretty steady.
But Europe absolutely surged, up 17% year over year.
Huge jump.
Meanwhile, their quote-unquote rest of the world category actually contracted. We are looking at a deeply fractured global spending environment.
Yeah, you could say that.
It is like analyzing a massive retail footprint where the North American flagship stores are holding steady, the European locations are breaking sales records, but the emerging market franchises are seeing foot traffic just dry up.
Well, I think the European surge requires immediate qualification, though.
Fair point.
Because a 17% jump in a mature market like European telecom is basically an anomaly.
Yeah, you do not just wake up and sell 17% more telecom software in Germany.
Right. Management clarified that this was not purely organic growth. A significant portion of that acceleration was actually driven by their acquisition of Profinit.
Ah, right, the European tech firm.
Yeah, back in December 2024. Because Profinit's revenue was not fully baked into the year-ago quarter, the year-over-year comparison looks artificially inflated.
So it is kind of an accounting illusion.
Well, it is a strategic win. I mean, they bought market share and capability in Europe, but it is vital to separate acquired growth from core product acceleration.
That distinction is so critical for anyone building a valuation model here. You cannot project 17% compounded European growth based on an M&A tailwind.
Exactly. And regarding the contraction in the rest of the world segment, Rappaport de Guim pointed out that this specific region operates heavily on a project-based model.
Oh, meaning it's not subscription revenue.
Right. Unlike a recurring managed services contract in North America, these international revenues fluctuate wildly based on the strict start and stop dates of localized implementation projects.
Very lumpy.
Super lumpy. She did note it improved slightly from the prior quarter, and they still have visibility for full-year growth there, but it highlights the reality of enterprise software deployment.
Okay, so moving down the income statement, we hit the profitability metrics, specifically the non-GAAP diluted earnings per share, which came in at $1.81.
And they explicitly touted this as a beat against their guidance range.
But reading the transcript reveals a vital mechanic behind that beat. It wasn't driven by an unforeseen explosion in software sales.
No, not at all.
Or a sudden massive expansion in gross margins. Management stated plainly that the EPS outperformance was primarily the result of a lower than expected effective tax rate for the quarter.
Which is exactly why we always dig past the headline numbers on talk tickers.
Seriously, if you just read a financial news ticker that says Amdocs beats Q1 EPS estimates, the natural assumption is that core business demand is accelerating faster than Wall Street modeled.
Yeah, you think they're selling products hand over fist.
Right. But a lower tax rate is fundamentally just an accounting dynamic.
Right. It pushes more profit to the bottom line, which mathematically inflates the earnings per share, but it tells you absolutely nothing about the underlying health of their telecom software adoption.
It is a temporary benefit, not a structural upgrade to the business.
Exactly. Though we do see structural improvements in their operating efficiency, however.
Oh, the margins.
Yeah, the non-GAAP operating margin expanded by 40 basis points year over year, hitting 21.6%.
And in an enterprise services business doing over $1 billion a quarter, a 0.4% margin expansion represents millions of dollars dropping straight to the bottom line.
Absolutely. And the mechanism driving this efficiency is a fascinating strategic loop. Management detailed how they are aggressively deploying generative AI internally.
Wait, so they're using AI on themselves?
Yes, using AI coding assistants and automation tools to streamline their own massive software engineering and operational workflows. They're basically shrinking their internal costs to serve.
And instead of just letting all those AI-driven cost savings pad the quarterly profit, they are heavily reinvesting that capital straight into research and development for their own commercial AI platforms.
Yep. They're using AI to build a cheaper internal operation, which funds the R&D to build more AI products to sell to their customers.
It is a brilliant self-funding innovation engine.
It really is.
Yeah.
And that operational discipline translates directly into the metric that truly anchors this stock's valuation, which is cash flow.
Oh, retail investors love cash flow.
Because net income can be smoothed out, And as we saw, EPS can be influenced by tax strategies. But free cash flow is the undeniable truth of a business's health.
Completely agree. And for Q1, they generated a normalized free cash flow of $237 million.
Yeah, and that is adjusting for $49 million in restructuring payments.
The pacing of that cash generation is what really stands out to me. The CFO noted that this $237 million single quarter performance represents roughly 33% of their entire full year free cash flow target.
Which is unusual, right? In a normal, evenly distributed business year, you would expect about 25% of your cash in Q1.
Right, a quarter of the cash in a quarter of the year.
So to pull in a third of your annual cash target right out of the gate is a massive display of working capital efficiency and collection strength.
It gives management an immediate war chest. And their capital allocation strategy with that cash is incredibly shareholder friendly.
Yeah, they did not just sit on it.
No, in just this 90-day period, they returned over $200 million to investors, $146 million in aggressive share repurchases, and $57 million in cash dividends.
They're shrinking the float and paying you a yield simultaneously.
It firmly establishes the profile of the asset. Whatever Amdocs is or isn't, they are undeniably a world-class cash-generating machine.
Unquestionably.
But to understand the sustainability of that cash flow, we have to pivot. We need to look at the underlying strategic moves driving these financials.
The deals.
Exactly. We need to dissect the actual deals that were discussed on the call, starting with the mystery we introduced at the very beginning of this deep dive, the T-Mobile paradox.
Yeah, this dynamic really dominated the analyst Q&A session.
I bet it did.
CEO Shuky Shepard announced a new 5-year agreement with T-Mobile, encompassing everything from foundational managed services to joint AI innovation. Yet, he simultaneously guided that total revenue from T-Mobile will decline in fiscal 2026.
It is a masterclass in how massive enterprise relationships actually function because they are rarely monolithic.
Right, people think of it as one big subscription.
Exactly. But think of a contract with a telco giant, like a multifaceted architecture project. You might hire a master firm to provide ongoing baseline maintenance for your entire global infrastructure.
Keeping the servers running, managing the daily billing loads, ensuring basic uptime.
That is the managed services piece. You sign a 5-year contract for that predictable recurring work. But simultaneously, you might also hire that same firm for a massive bespoke integration project.
And in this specific case, that massive integration project is T-Mobile's acquisition of US Cellular.
Right. When a telco buys another network, they don't just physically connect the cell towers.
Oh no, they have to undertake the agonizingly complex process of merging millions of customer accounts, historical billing data, legacy network protocols, and CRM databases into a single unified operating system.
And Amdocs is the architecture firm hired to execute that exact digital integration.
Right, and integration work is, by definition, finite. It requires a massive surge of engineering hours, customized coding, and heavy lifting to map US Cellular's data onto T-Mobile's Amdocs Run stack.
So T-Mobile pays a premium for this surge.
Exactly. But as the CEO pointed out, these activities are fundamentally non-recurring. You only integrate a purchased company once.
Okay, so as the US Cellular integration reaches its later stages and the heavy lifting is completed, that specific, highly lucrative revenue stream naturally ramps down.
Yes. Furthermore, management noted a broader trend with T-Mobile, indicating a general lower level of spending appetite for discretionary modernization projects right now as they digest their recent acquisitions.
So you have a baseline 5-year managed services contract that remains totally stable.
Yeah.
But the massive one-time integration surge from the US Cellular deal is evaporating, and T-Mobile isn't immediately replacing it with new discretionary projects.
The net result is a highly secure client relationship that will generate slightly fewer total dollars this fiscal year.
It perfectly illustrates why you cannot trade enterprise software stocks based purely on press release headlines.
Oh, definitely not.
I mean, a headline blares, Amdocs secures 5-year renewal with largest client, which sounds like an immediate growth catalyst. But the granular reality is a revenue step down.
Yeah, you have to read the transcripts to understand the life cycle of these mega projects.
For sure. Now, the second major strategic maneuver we need to break down is their sudden capital deployment at the very end of the quarter. Amdocs executed a $197 million all-cash acquisition of a California-based company called Matrix Software.
Yeah, and on the surface, this raised some eyebrows. What do the analysts actually press them on it during the call?
I saw that because about 5 or 6 years ago, Amdocs made a massive acquisition of a company called Openit, which was specifically designed to provide next-generation charging and monetization platforms for telcos.
Right. So the obvious question is, if you already spent a fortune acquiring a premier billing and charging engine, why drop another $200 million in cash for Matrix software, which seemingly does the exact same thing?
What was management's excuse?
Well, Shiki Shepard's response provided an excellent map of the current telecommunications hierarchy. He explained that the telco market is highly segmented.
Okay.
Amdocs' legacy systems and the Openit platform they acquired previously are engineered for Tier 1, massive-scale global operators. We are talking about the AT&Ts and the Verizons of the world.
The absolute behemoths.
Right. These massive operators require charging systems capable of handling infinite complexity, millions of concurrent sessions, intricate enterprise data slicing, and deeply customized legacy integrations.
Got it. And Openit is the heavy-duty engine built for that extreme end of the market.
Exactly. Yeah. But the growth in mobile right now is not just coming from the massive incumbents. A huge part of the market momentum is in Tier 2 operators and the MVNO space.
MVNO, Mobile Virtual Network Operators.
Right. For anyone unfamiliar, an MVNO is a company like Mint Mobile or Consumer Cellular.
Okay, right.
They do not spend billions building physical 5G cell towers. They lease wholesale network capacity from the major carriers and resell it to consumers under their own agile, often lower-cost brands.
And an MVNO has entirely different software requirements than a Tier 1 giant.
Oh, completely. They don't need a monolithic, endlessly customizable IT stack that takes 2 years to deploy.
Right.
They need agility. They need a charging engine that allows them to spin up a new promotional data plan in 48 hours, launch it to the market, and bill for it instantly from the cloud.
Oh, I see. That is the exact product architecture the Matrix software mastered.
Exactly. Matrix provides a highly productized, nimble monetization layer specifically tailored for that mid-tier and MVNO market segment.
Wow, so it is a textbook market consolidation strategy. Amdocs already dominated the premium, heavy-duty enterprise tier. Now, by swallowing Matrix, they have an off-the-shelf, agile solution for the fastest-growing disruptor segment of the market.
Yep. But honestly, the software itself might be secondary to what they really bought for that $197 million.
Oh, what do you mean?
The client roster.
Ah.
The inherited customer base is a massive strategic asset. Matrix brings entrenched relationships with players like Verizon, TELUS, Telefonica, Swisscom, Virgin Media, O2, and Telstra.
Wow. Getting your foot in the door with a major carrier is historically the hardest part of enterprise sales. Amdocs just bought their way into the IP departments of several massive global players where they might have previously been locked out or underpenetrated.
Right. The cross-selling potential is obvious. They can go to a Swisscom, who's currently just using Matrix for billing, and suddenly offer to handle their entire cloud migration or managed services portfolio.
It solidifies their defensive moat.
It definitely does. Shepard was very clear that this combination makes Amdocs the undisputed dominant market leader in charging and monetization globally.
But defensive moats don't drive long-term multiple expansion on Wall Street. Technological disruption does. And that brings us to the centerpiece of their strategic narrative for the future. AOS.
Right, the agentic operating system.
Yes, Amdocs is heavily promoting this, preparing for a massive official launch at the upcoming Mobile World Congress in Barcelona.
Yeah, they are pushing it hard.
Now, we have to look at this with a highly critical eye because agentic AI is rapidly becoming the most abused buzzword in corporate America. Every tech CEO is throwing the word agent into their earnings script to try and catch an algorithmic bid on their stock.
Oh, completely. It's the new buzzword bingo.
So we need to dissect what AOS actually is. Is this a structural revolution in how telecommunications networks are managed, or is it just a newly branded customer service chatbot?
Well, management spent a considerable amount of time drawing a hard line between those two concepts.
I would hope so.
They stressed that the telco industry's initial foray into AI over the last 2 years has been largely opportunistic,
Right.
which is exactly what a standalone chatbot represents.
Right. A customer types a query, a Gen AI model summarizes an FAQ page, and it spits back an answer.
Yeah, it's a localized point solution that marginally improves call center efficiency. AOS is designed to be a fundamental departure from that model. They are positioning it as a strategic, holistic foundation for the entire enterprise.
Let us ground this in the mechanics of how these networks actually operate. The IT architecture of a legacy telecom company is notoriously fragmented.
Oh, it's a mess.
You have billing systems built in the 1990s, bolted onto CRM databases from the 2000s, interacting with modern 5G provisioning nodes. It is a chaotic web.
Yeah, totally.
Historically, if a customer wanted to execute a complex action, say, setting up a specialized international roaming pass that restricts certain types of data usage for a specific dependent on a family plan.
A nightmare scenario for IT.
Right. A human operator at the telco might have to manually click through 4 or 5 completely different legacy interfaces, reading data from one system and keying it into another just to execute that one workflow.
And that manual swivel chair integration is where errors happen and where operational costs explode.
Swivel chair integration. I love that term.
Yeah, it's very descriptive. AOS is designed to sit as an intelligent, overarching layer on top of that entire fragmented BSS-OSS infrastructure. The key differentiator of agentic AI, as Amdocs defines it, is autonomy.
Okay, so not just a chatbot.
Right. Instead of just answering a question, an AOS AI agent is given a goal. It understands the complex intent of that roaming pass request, autonomously navigates through the various underlying billing and provisioning systems, writes the necessary code to update the databases, and executes the end-to-end workflow without a human ever touching a keyboard.
Wow. It transforms the AI from a conversational interface into a digital workforce that actually operates the network infrastructure.
That is the goal, yeah.
It is a massive technological promise. But enterprise software is littered with slide decks promising revolutionary automation. As investors, we demand proof of concept.
Naturally.
Are massive risk-averse telecom companies actually trusting Amdocs' AI to touch their live systems today? Or is AOS just a theoretical framework?
Well, the earnings call provided several concrete live deployments that validate the demand. They highlighted a major partnership in Canada with TELUS and NVIDIA.
Okay, TELUS.
They are deploying an advanced AI-powered quality engineering solution specifically on what TELUS calls their sovereign AI factory.
We should pause on that term, sovereign AI, because it is becoming a massive macro theme.
Oh, absolutely.
Telecom networks are classified as critical national infrastructure. A company like TELUS cannot legally take sensitive Canadian cellular data, pipe it down to a public AI server in California for processing, and send it back.
No, the data residency laws and national security mandates forbid it entirely.
So Amdocs is proving they can build and deploy these sophisticated AI engineering agents entirely within the localized, highly secure, sovereign borders of the client's own data centers.
And that capability is a massive barrier to entry that keeps generalized tech competitors out of the telecom space.
Makes sense.
They also detailed ongoing work with AT&T, where they are applying AI-driven migration capabilities to accelerate the movement of core infrastructure into the cloud.
Massive undertaking.
And perhaps most indicative of the AOS vision, they are heavily engaged with Vodafone Germany. Vodafone is undertaking a massive project to decommission deeply entrenched legacy technology stacks and move those workloads to the public cloud.
And Amdocs is using AI for that.
Yes, Amdocs is actively using generative AI tooling to untangle that legacy code and automate the migration process, dramatically increasing the efficiency of the delivery.
So they aren't just selling the dream of AI, they are actively billing for AI-driven operational improvements in the field today.
Yeah. Exactly. The AOS launch at Mobile World Congress is essentially productizing these discrete AI capabilities into a unified marketable platform.
Got it.
Management firmly believes this platform will become the next major structural growth engine for the company as telcos desperately look for ways to simplify operations and cut overhead.
Before we move to their financial projections, we must address one final massive piece of context from the quarter, a structural shift in the leadership.
Right, the CEO transition.
Shuki Shepper announced his retirement after an incredibly consequential 7-year tenure as CEO. He will be stepping down and handing the reins to Jimmy Horvick on March 31st, 2026.
Which is usually a pretty big deal.
Yeah, a CEO transition at a $9 billion enterprise software company is usually a moment of extreme vulnerability.
Wall Street hates uncertainty.
And a new CEO often means a kitchen sink quarter, where they reset expectations, write down bad assets, and pivot the strategy, which usually sends the stock plunging.
True. But analyzing the anatomy of this specific handover, it is designed to broadcast absolute, unshakable stability.
How so?
The timeline alone proves that. Shepper is giving well over a year's notice before vacating the seat.
Wow.
A year. Furthermore, this is a deeply internal succession. Jimmy Horvick is a long-tenured executive who was sitting right alongside Shepard during the earnings call. He has been intimately involved in crafting the exact cloud and AI strategies we just discussed.
When Horvick spoke on the call, his message was purely about continuity. He emphasized maintaining the established engineering culture, preserving the deep-rooted trust of their Tier 1 customers, and executing on the AOS roadmap.
Right. This is not an external disruptor coming in to break furniture and change the business model.
It is a highly choreographed passing of the baton, engineered specifically to ensure massive clients like AT&T and T-Mobile that their multi-year digital transformation projects will not skip a beat.
So we have the Q1 results, the strategic M&A, the AI platform launch, and a planned leadership transition.
Yeah.
The question now becomes, how does all of this translate into future financial performance?
Yeah.
When we look at management's guidance for the rest of fiscal 2026, we have to evaluate whether the operational reality matches the forward-looking narrative.
For the full fiscal year 2026, management reiterated their expectation for total reported revenue growth to land between 1.5% and 5.5%.
Okay.
If we look at it in constant currency, stripping out the foreign exchange noise, that range tightens to 1% to 5%.
Which, on the surface, that looks like slow, steady, utility-like growth.
But applying our Talk Tickers framework requires us to pull those numbers apart because the Q&A session revealed a very different dynamic under the hood.
Yes, the exchange between the analysts and the CFO regarding the composition of that growth was the most revealing segment of the call.
I was running the math as I read the transcript, and the underlying growth narrative completely fractures when you isolate the variables. Tamar Rapaport-Dagim explicitly acknowledged that roughly half of their projected growth for the year is inorganic.
Half of it.
Meaning, half of that 1% to 5% growth isn't coming from Amdocs selling more of their core software. It's simply the mathematical result of adding the newly acquired Matrix software revenue onto the balance sheet.
Which leads to a pretty sobering conclusion. If you strip away the M&A sugar high, the organic top-line growth of the legacy Amdocs business is practically flat.
Right.
Depending on where they land in the range, organic growth could be hovering around 0 or maybe 1%. For a technology company pivoting into the AI revolution, a flat organic top line is undeniably sluggish.
It forces you to question the immediate demand environment. However, Rapaport-Dagim vigorously defended that guidance by pointing out the distinct structural differences between the core business and what they just bought.
Yeah, because Matrix is fundamentally a software product company. You sell a license, you recognize the revenue, it is inherently lumpy.
Right. And Amdocs' core DNA is massive, multi-year managed services contracts that provide incredibly smooth, predictable revenue recognition.
Because they are integrating this lumpy, less visible software product model into their historically predictable forecasting engine for the very first time, the CFO stated they are intentionally adopting an quote-unquote appropriate to conservative stance.
On how much Matrix revenue they are baking into the full year guide.
Right. They are acutely aware of the risks of overpromising on an acquired asset in year one.
So there is a very real possibility they are sandbagging the numbers.
Oh, entirely possible.
They set a low bar, fully expecting the combined sales force to cross-sell Matrix into their Tier 1 base, allowing them to consistently beat and raise as the year progresses.
It's classic corporate expectation management.
But even with that caveat, you cannot ignore the math. Organic growth right now is stagnant.
We also have to factor in their profitability guidance. They are targeting full-year operating margins of 21.3% to 21.9%.
Which represents a modest but solid 20 basis point improvement at the midpoint compared to the prior year. They are continuing to squeeze out operational efficiencies.
However, the CFO issued a highly specific warning regarding the Q2 modeling that investors must incorporate.
The tax rate dynamic is coming back to haunt the next quarter.
Precisely. They project their effective tax rate for the full year will normalize between 16% and 19%. But she warned that due to the timing of specific global tax obligations, the effective tax rate in the fiscal second quarter will spike significantly above the high end of that annual range.
This is a crucial mechanical detail. If you are holding this stock through the next earnings print and you see the Q2 EPS number come in light, you cannot panic and assume the business is deteriorating.
Right. Just as a low tax rate artificially inflated the Q1 EPS, a high tax rate is going to artificially suppress the Q2 EPS.
It is a timing issue, not a fundamental collapse in software demand. You have to look past the bottom line distortion and focus on operating income and free cash flow.
And if you are concerned about that flat organic growth and the lumpiness of the telecom spending environment, management provided the ultimate countermetric to soothe investor anxiety.
Oh, the backlog.
Yes. They reported a 12-month backlog of $4.25 billion.
That backlog figure was up 16 million sequentially from the prior quarter and up 2.7% year over year.
Let's break down exactly what a backlog is in this context, because it is the fundamental bedrock of the bullish thesis for Amdocs.
Good idea.
This is not a quote-unquote pipeline. A pipeline is a list of potential clients who might buy your software someday. A pipeline is hope. A backlog is contractual reality.
Right.
The $4.25 billion represents legally binding signed agreements for software and services that Amdocs expects to definitively recognize as revenue over the next 12 months.
When you compare that $4.25 billion locked-in figure against their total annual revenue target of roughly $4.6 to $4.8 billion, the level of visibility is staggering.
It really is.
It means that if the global macroeconomic environment completely seizes up tomorrow, if interest rates spike, a recession hits, and every single telecom CEO in the world instantly freezes all new discretionary IT spending. Amdocs already has the vast majority of its revenue for the next year sitting securely in the vault, just waiting for the calendar to turn.
That backlog acts as an incredibly dense shock absorber against short-term market volatility. It is why this stock doesn't trade like a high-flying speculative sauce company.
Which brings us to the synthesis of all these moving parts. Taking the $1.15 billion in Q1 revenue, the paradox of the T-Mobile step-down, the $197 million Matrix acquisition, the ambitious AOS AI rollout, and the heavily insulated backlog. What is the definitive takeaway for the retail investor?
Well, if we boil this down to a core thesis, the verdict on DOX is what I would call cautiously bullish.
I like that. We are looking at a classic cash cow with an AI kicker.
Exactly. Let's be very clear about what you are buying here. You are not buying a hyper-growth tech disruptor. You are not going to wake up to a massive 30% year-over-year revenue leap.
No. Top-line organic growth is demonstrably sluggish, and massive clients are taking a breath on major integration spending. But what you are buying is one of the most reliable, deeply entrenched, recession-resistant cash compounding machines in the public markets.
The financial metrics supporting that cash cow label are undeniable. Management is projecting roughly $710 million to $730 million in normalized free cash flow for the full fiscal year.
That equates to an astonishing 90% free cash flow conversion rate relative to their expected net income.
Almost every single dollar of accounting profit this company generates is converted into cold, hard cash.
And if you look at their current market capitalization, that cash generation translates to a free cash flow yield of roughly 8%.
8%, that's massive.
Finding a deeply moated technology company with total revenue visibility and an 8% FCF yield in the current market environment is incredibly rare. It is a value investor's dream.
And their philosophy on capital allocation ensures you get paid while you hold it. They are committed to returning the vast majority of that free cash flow to shareholders.
The stock currently offers a dividend yield of around 2.7%.
And they are armed with an $840 million remaining share repurchase authorization. They're going to continuously buy back their own stock, mechanically increasing your ownership percentage and supporting the share price.
So the actionable insight is clear. If you already hold DOX in your portfolio, you are in a phenomenal position. You are getting paid a solid 2.7% yield to simply wait.
You sit back, let the $4.25 billion backlog protect your downside, and watch them execute on the Matrix integration and the AOS platform rollout.
If you were sitting on the sidelines considering initiating a position, you have to accept the reality of the slow organic growth. You are buying this for the steady compounding and the immense capital return, not for immediate top-line fireworks.
The variable that could change that equation, the potential catalyst that could transform this from a slow and steady utility tech play into a multiple expanding growth story, is the AI kicker.
Over the next 12 to 18 months, the market will be hyper-focused on the adoption rate of the AOS platform.
If telcos view AOS merely as an incremental upgrade, the stock remains a steady cash cow. But if management is right, and AOS becomes the foundational operating system for telecom's AI era, unlocking massive new efficiency budgets, then Amdocs suddenly regains a formidable growth narrative.
That adoption cycle is the single most important metric to track going forward. But as we wrap up this deep dive, that exact AI narrative leads me to a fundamental, almost philosophical question about the future of this company.
Ooh, okay.
I want to leave you, the listener, with a provocative thought based entirely on the strategic realities we just unpacked.
It centers on the inherent tension in their business model transition, doesn't it?
Exactly. Look at the revenue breakdown. The CFO confirmed that roughly 65% of Amdocs' entire revenue base is derived from managed services.
Right.
Telecom companies pay Amdocs billions of dollars every single year to provide human expertise, software maintenance, and manual operational oversight to keep these incredibly complex, fragmented IT environments running. Managed services is the bedrock of their cash flow.
It is a massive recurring revenue stream built on the necessity of human intervention in legacy systems.
But look at what they are building with the agentic operating system. AOS is explicitly designed to autonomously execute end-to-end workflows.
Right. Without humans?
It is designed to navigate complex BSOSS environments, provision services, and solve billing errors using AI agents, completely removing the human element from the equation. The stated goal of AOS is frictionless automation.
The implications of that capability are profound for their own balance sheet.
Right. If AOS is actually as successful as Shuky Shupper and Jimmy Horvik claim it will be, are they essentially building the exact technology that will eventually cannibalize their own core business?
Well,
If a sovereign AI agent can execute complex network workflows instantly, autonomously, and flawlessly, why on earth would AT&T or T-Mobile continue to sign 5-year, multi-billion-dollar managed services contracts for armies of Amdocs engineers to manage those exact same workflows?
it is the purest manifestation of Clayton Christensen's innovator's dilemma.
Exactly.
Do you ruthlessly disrupt your own highly profitable legacy business model, or do you wait for a leaner AI-native startup to do it for you? Amdocs is clearly choosing to be the disruptor.
Their internal bet is that the software licensing fees and the immense value created by the AOS platform will outpace any inevitable decay in the traditional human-led managed services revenue.
But it requires executing a massive structural transition of their economic engine while flying the plane.
It is an incredibly high-stakes tightrope walk. Will the AI kicker ultimately cannibalize the cash cow? That is the foundational question you need to model out. Keep digging into the SEC filings, track the granular progress of the Matrix integration, and watch how T-Mobile structures their next wave of IT spending.
Good advice.
Earnings reports are never just binary pass-fail grades. They are complex ecosystems of accounting choices, integration life cycles, and massive strategic gambles. Keep looking for the actual signal hidden beneath the corporate noise. We will see you on the next Deep Dive.